Wake up. Hello, everyone. Wade Comeaux and Jeff Johnson here today from Catalyst Funding.
Nope.
Unfortunately, our guest was unable to attend, but we are very excited about going over some great data today. Thank you, David, once again for helping put all of that together. Um, let's dive right in. So, quick disclaimer, this presentation is for general information only. We're not presenting anything here as investment advice. You should always do your own due diligence. And we're not making any guarantees. No guest speakers or Jeff or I are making any guarantees of investment returns or giving any specific investment advice. By attending, you acknowledge and agree that Catalyst and its agents do not assume any liability for any loss or damage caused by the information contained within the presentation. All right, so the next slide, our value proposition. For those of you that do not know, we are a one-stop shop for hard money and permanent financing loans. We are real estate lenders built by real estate investors. We own a pretty large single-family rental portfolio in another company. We've also flipped hundreds of deals over time. We've been involved in thousands of transactions. We try to take that information to help you succeed as a lender. And then we also have a very unique model in that we have a single point of contact for all of your loans. And with one credit pool, one soft credit pool, you can get pre-approved for a wide variety of products, including um, owner-occupied loans. You can do a cash-out refi on your primary residence, or you can do purchase a new primary residence, and of course, our core products of hard money loans, which are the money to purchase and repair distressed real estate, as well as conventional refis of those hard money loans, and also DSCR loans. DSCR loans are incredibly popular right now, and even if you do not have consistent documentable income, either from a business or from a W-2, you can get qualified to own cash flowing properties with what's called a debt service coverage ratio or DSCR loan. So that means no income docs have to be provided, and you can get excellent terms that allow you to hold that property long term. Um, and I think that hits the gamut. Jeff, anything to add on our value proposition?
No, I was just going to mention a couple of things. Like you said, we're doing a lot of DSCR loans right now. So if you're an investor or want to be an investor and you want to do rentals, but weren't quite sure how to do it because you don't, maybe your tax returns, you write a lot of stuff off. That's an option. That's a great option. Pricing is very similar. Conventional loans are still going to be a little bit better, but it's not a lot. So if you like I said, if you want to be an investor and you're not quite sure about your ability to get approved for a conventional loan, don't sweat it. Call us, talk to a loan officer. They can give you the options. If you are able to get conventionally approved, 9 times out of 10, you should take that because it's going to be a little bit better pricing. The only other thing I would mention is that in my opinion, we're going to go over the data and you're going to see some what I think are buying opportunities for investors. Um, a lot of folks we're starting to get a lot more applications for people doing cash outs, like pulling
Yes.
cash outs out of rental properties or sometimes even their owner occupied properties if there's a ton of equity there, because there's a lot of data that's going to show it's a really good buyer's market right now for investors. And you can take advantage of that by dumping a lot of cash, getting it out of your properties that are just kind of sitting there and buying a lot more because now it's a good time.
Yeah, most people have owned their property for 4 or 5 years. If you owned your property for 4 or 5 years, you probably have, depending on the city, which we go over here, 40% equity in that property. And that should be fuel for your real estate investment goals. And while you may have a low interest rate there on that property, that interest rate might save you, hundreds of dollars versus what the increased rate, if you did a cash out, would save you. So it might be, let's say it's 400 bucks in savings. You can use that money to buy, 10 properties. You might have 2,500 in cash flow from those 10 properties. And that is a complete game changer. Plus, at the end of the rainbow, you don't just have one property with a lot of equity in it, you have 11. So, in almost every circumstance, if you make an objective math-based decision, it is the better decision to increase your interest rate, do a cash out, and invest. It doesn't sound as good at dinner parties sometimes to say, oh, I don't have a 2% rate anymore or a 3% rate anymore. But as far as your overall financial situation and creating generational wealth for you and your family, it's an absolute no-brainer.
Yep.
All right, let's dive into Houston. Jeff, what do you see in the Houston numbers?
Sure. So I'll cover some of it and then we can talk about it. So home sales, 8,700, relatively flat, only up 2% year over year. If you look at listings, however, there's almost 60,000 listings relative to roughly 50,000 this time last year, and 42,000 6 years ago. But if you look at the number of sales, say 6 years ago and this year, it's pretty flat, right? 85, 86, 87, very consistent number of sales, but the listings 42,000, 49, 50,000, 49,000, and almost 60,000. You can see that there are a lot more opportunities for buyers because there's just a lot more homes on the market relative to the number of sales. Now, with that, you would expect the prices to drop, but if you look at it, Houston's flat. $424,000 is the average sales price year over year. Relative to October, it's flat. Median sales price is 330, which is a slight dip, 335. So we're talking about a 1% dip in the median price. Months of inventory is up to 5.2. Pending sales are 7,800 and days on market of 59. So when I look at Houston, I think it's a great opportunity to pick up some properties because for a lot of reasons, there's some slides down the way that they're going to talk about this, but it is not quite a buyer's market, but it is no longer a seller's market. I was looking at this. 0 to 5 is considered a seller's market. 5 to 7 is kind of neutral, and then 7+ is a buyer's market. So it is definitely not a seller's market, and it seems like it's trending a little bit towards the buyer's market. So I just look at those listings relative to sales, and I see all the opportunities to pick up properties.
Yeah. And the great thing is that prices across Texas, especially in Houston, are not going down despite a lot of headwinds. At the end of the day, interest rates are significantly higher than what they were a few years back. So people are reluctant to give up that lower interest rate that they have on their primary residence. So there's not a lot of transactions taking place. But for people who are doing buy and hold investing, this is a great time because you can get better deals at this moment for sure.
Yep.
And the other thing that I'll say is both auction.com data, we don't have it on this slide, but we presented it recently at the deal, well, the lunch and learn deal lunch that we did recently.
Deal
And
night lunch thing.
yeah, and we as a company, the numbers very closely align with the auction.com data, but whenever interest rates were lower, the average investor was paying about 92, 91% of the afterwards repairs valued less repairs. So for example, on a $100,000 property, they were paying 91,000 less repairs. And in this current environment where rates are higher, it's around 72%. So it is a massive difference. So if you think the answer is I'm going to wait until interest rates come down to get good deals, you're going to end up paying way more for those properties. Yes, it's going to cash flow more without question because the interest rates are lower, but your return on investment is really what you should look at. Savvy investors understand that ROI is really the bottom line. Cash flow is a simplistic number. It's easy to understand, but it's not the right number to look at because if you're out of pocket 100K to make $500 a month, that's a bad decision. If you're out of pocket 10,000 to make, 100 bucks, that's a way better investment. Even though 100 is less than 500, the return on your investment is exponentially higher.
Yeah. The other thing I noticed down there, if you look at the lease price, kind of to your point, because yes, if you buy a property now, your cash flow will be not as great as it once was. Fair. But like Wade was saying, also, you're able to buy a lot more properties with a lot less money. And if you look at the lease price, if you bought a property 6 years ago, that and just in raw dollars, the difference in 6 years ago is almost $500. It's like 467 difference. So your cash flow is going to go up $467 minus an increase in taxes and insurance. I get that. That's fair. But you know, on the whole, the leases will typically outpace all of your expenses. So each year, each renewal should get a little better and a little better. And then there's the event of a refinance. If and when rates drop to the point where it makes sense to refinance, you could do that. And that's an instant. Typically, that's an instant couple $100, right? So
Yeah,
so if you look at the downside to buying now, is it okay? Yeah, minimal cash flow, but you can buy a lot of properties. And there's nothing but upside coming. I guess is what is the downstream
sure. And still, if you look at it, before we move on from the slide, the appreciation, while it's relatively flat at the moment when we're in a higher rate environment, if you look at it from pre-COVID, up 41 to 42%. And I fully believe once rates come down, we're going to see there's massive pent-up demand right now. If prices are not dropping in this current environment, they're going to do nothing but go up whenever the dynamics change. And if you look at the bond market, the bond market is saying that rates are really going to come down in 2026, and that I think a lot of this buyer's market is going to transition. So it's really a golden time, and it's not going to be around forever.
Yeah. Last thing I'll say, then we move on. Because Wade, you mentioned earlier, it's a good time for buy and hold people. Flippers can still operate in this market. They do operate in this market.
Absolutely.
We do loans for folks that make a killing on their flips all the time. You just have to adjust a couple of things. Days on market, 59, right? You have to just kind of know what you're getting yourself into when you flip a property. Um, and that all boils down to the buy. It's simple as that, right? If you have a good handle on your construction expenses, you have a good handle on your ARVs and what the market looks like, it's simply math at that point and negotiating. And the good news is that there are 59,000 listings to choose from, versus 40 some odd 6 years ago. So you can still flip properties. People are flipping properties all the time. We got a couple that's doing a new one. I think they're closing one in a week, and they're already have another one under contract ready to go. So you can flip and flip well. You just have to buy them right.
Yeah. If you buy right, you put out a top of market product at slightly below market price. If you can make those numbers work, then people are doing that very successfully. And they're
Yep.
not staying out there 59 days on the market whenever you put those things together. If you're trying to do an inferior product and put it out at market price, then it's just not going to work out. Those are the properties that really sit.
Yep. 100%.
All right, let's pop over to Dallas. So, Dallas was and still is the highest appreciation market since pre-COVID, just massive appreciation. We're talking about a 6 year period, median being up 48%, the average being up 59%, just an amazing story. But the last year, it is down a bit. It is definitely cooled a little bit, but that's not significant considering the overall market. But the listings are not nearly as significant as they are in Houston. There's a lot fewer
Mm-hmm.
listings. Now, this Dallas metric in all candor does not include all the areas. Dallas doesn't, doesn't include Fort Worth, whereas Houston's kind of the entire greater Houston area. There's some things taken out of this Dallas number, so it's a little bit misleading. But I think the overall trends on the averages you can definitely see. The months of inventory is still significantly lower than Houston, but the days on market is comparable. In fact, above 60 days. And if I remember correctly, I think Houston was below 60 days. So
Houston days on market was 59. Correct.
yep. So comparable markets in many ways, but I think the biggest thing is that if you're a real estate investor looking at single family 1 to 4 properties up in Dallas, you're probably going to have to go farther outside of the center of the city just because the price point is higher, but the rents are not uh, that high. That they're not so much higher that they make up for that difference of price, right? Because you're talking about an average lease price in Houston of 2,200, an average lease price in Dallas of 2,600, but the average price more than eats up that difference. So that's why Houston, especially inside the major parts of the city, is a better overall single family 1 to 4 investment opportunity. But you do look at that average lease price in Dallas, the appreciation has gone up more. They're up 37% and up 4% year over year. You look in
Yeah.
Houston,
Houston
we're
was
talking about 1% and only 26%. So the Dallas success story on increased rents is really significant. And if you look at the raw number from pre-COVID being up $700, that is enormous.
Plus Dallas, if you look at like last year, if you look 24 to 25, Houston was pretty much flat. It was like up $12. Dallas is still kicking. Like that's almost $100 difference between 24 and 25. And I know days on market is 64. That seems higher than usual for Dallas. Sure. The average days on market in the country is 63. So it's
Yeah.
right in line. So it's not a panic mode or anything like that. Like I said earlier, the buyer seller neutral month 4.4. So I guess technically based on those standards, this is still a seller's market. I don't think Dallas, like to your point, I don't think Dallas um, has had much of retraction. Like if you look at the sales, they're still relatively flat. The sales are slightly up. Like that ratio is pretty consistent. Now, 19 was pretty hot, like a lot of sales relative to listings. But I think look at this year versus last year, 7,000 out of 31. Houston is maybe 9,000 if you're being generous out of 60. So it's a lot quicker market in Dallas for sure.
Absolutely. Let's pop over to San Antonio. What are you seeing there, Jeff?
Sure. So I'll just run through some of the numbers and then give a little take. So home sales in San Antonio are down slightly, 10%, 2,600. Sales versus 2,900 and 2,900 if we're rounding. Listings are down actually, so it would make sense if you look at the sales versus listings this year versus last year. It's probably about the same. Average sales price is up 1%. Median sales price is down 1%. If you look over the long haul, COVID, that average price 30 plus 36. I looked it up earlier. Like historically, real estate prices increase 4 to 6% per year. So if you say 5 and 6, it's 30%. So it's pretty right in line with where you would expect it to be. Um, Months of inventory 6, pending sales 2,300. I will say the number that was a little surprising was the 83, the days on market. Like that's a big jump going from 69 to 83. That's pretty significant.
Yeah.
So I definitely wouldn't turn a blind eye to that. If you're looking to flip properties in San Antonio, again, buy them right, rehab them the right way, price them right, and assume that you're going to have your property on the market for 83 plus days. Now, maybe like Wade said earlier, if you do a good job and you do a great rehab, you price it slightly below what you should be priced at, that you shouldn't expect this 83. But run your numbers, buy it correctly, you can still flip. But I would think 83 days on market, I would see that as a great opportunity for somebody to come in and start grabbing some of these maybe uglier houses off of MLS. I know wholesalers drive a lot of the business, and that's not going to change, but you might be able to pop over to MLS and pick up some properties that maybe need some TLC and have been sitting for a while.
Yeah. I I would say this. You're making a mistake if you have a property on the market 83 days. The market has already told you that your price is too high. I've had to sell off a few single families to take advantage of some other opportunities, and I'm up to about sold 6 now. I haven't had anything that lasts anywhere close to what the average days on market is. If you're doing that, you're just making the wrong decision. You're not responding to the market. If you aggressively lower your pricing, uh, and you price and you put out a good product, I, I'm really not seeing any of that at all. It's all the market will tell you where you need a price, and you can sell it pretty quickly.
Yeah,
It's not like people look at your property for 83 days and then decide to move forward. It's just not priced right.
yeah. And even with these numbers, like 83 days, that seems like that's a big number. Even with months of inventory 6, that's still considered a neutral market. So for as much as we're talking about, hey, buyers is a great chance, and I do think it is. It's still technically considered a neutral market. So we have a lot of recency bias, over the last 5 or 6 years as to what is a normal months of inventory.
Sure. All right, let's pop over to Austin. And, Austin is an interesting success story. They had really had the biggest pullback of all the markets in price, but year over year up 5% in Austin. That's a very, very strong number. It looks like Austin may have kind of bottomed out and is making a comeback. That's the most positive momentum that I see. Their months of inventory is one of the better numbers out there. For a while, they have been had a lot more inventory than the other markets. The days on market was the highest of all the markets, and that is coming down in that direction. It's down 7% year over year, still up slightly on months of inventory, but um, and then the active listings, if you look at the from pre-COVID, obviously a huge increase, but from year over year, it's one of the smaller increases out of the major markets. So some real
Yeah.
positive trending in that Austin market, which, if you look at national prognosticators on places where they expect there to be a lot of appreciation, I think Austin is still something ranked very highly. A lot of people moving into the market, a lot of very high paying jobs in the tech industry and white collar jobs. So I do think that there's a lot of upside in that market, but it's not the easiest market to have a cash flowing rental in the downtown area, just like Dallas. But there's some people that are really crushing it outside of that, outside of that area, like in the
Yeah.
suburbs, a little further out.
Yeah. I just like if you just look at Austin relative to the other cities last year, like year over year. So, for example, Houston has gone from 4.4 to 5.2 months of inventory. Austin 5.1 to 5.3. So, like, it kind of caught up, I guess, with Houston. Same thing with Dallas. Actually, Dallas is still a little better, but San Antonio 5.1 to 6. They were San Antonio and Austin were both at 5.1. A year later, San Antonio's up to 6. Austin's only 5.3. So, like, it's a better market to your point. Like, if I own a piece of property in Austin, I'm happier because I feel like things are moving in the right direction. For real estate investors, it may be a little more challenged to find a deal in Austin proper. Like you said, you can look at multifamily, like small multifamilies, or move outside of the area a little bit for opportunities. But if I have property in Austin, I'm happy because I think values are starting to go back up, and they will probably stay that way for a while.
Yeah, it looks like I think they hit their bottom. Seems like they bounced up for sure.
Yeah.
All right. Um, this is some data on nationwide existing home sales, and we have definitely experienced this in our personal business. As we mentioned earlier, we do provide a lot of long-term loans, and this is long-term loan data. This is not hard money loan data, but you can see the existing home sales rose 1.2% month over month and 1.7% year over year. The median home price is up about 2.1% from a year earlier. And this marks 28 straight months of year over year price increases nationwide. So definitely some positive momentum. But while rates may seem like they are low, I'm sorry, high, they are lower than they were a year ago by a significant margin. Um, we're down about 1%, 1.5% from the peak, depending on exactly when you look at the time frame, and interest rates change from day to day. So that's a very attractive reduction. And then when we'll go over the historical rate chart, where we are today is historically lower than the average, although it's not as low as it was during the COVID period whenever we had the lowest rates in history. So I think that we've talked about this on every one of these calls, and we talked about it earlier. There's a lot of pent up demand, and very small shifts in interest rates are going to push people that have been sitting on the sidelines waiting to move back in. And that's what we're seeing right now.
Yep. Yep. Well said.
Jeff, you want to take this?
Yeah, so this is we've been talking about this for a while now, but it's interesting to see numbers. So Texas population expected to hit 42.6 million by 2060, which is 35 years from now. Population increase due to migration trends rather than natural increase. So this is people moving into Texas as opposed to an increase in birth rate. The Texas Triangle is heavily concentrated DFW, Austin, San Antonio. But the interesting part is causing sprawl into suburban ring counties. So, obviously, like we talked about in Dallas and maybe Austin proper, like you're going to see those prices really, really go up. But it's the outlying communities that are going to start seeing significant growth as a percentage. There's a slide later down to kind of talk about that and give an example. But, the major metros in Houston, Austin, San Antonio, Dallas, um, are seeing a huge surge. Now, it's interesting. West Texas counties are losing population. Not sure what the logic is behind that, but a lot of folks in West Texas are heading out and moving away. So those are very negative. Most of the counties in Texas, if you look at it, are probably flat or negative, but the green ones are seeing a massive influx in people.
Yeah. This is an interesting chart because I've been hearing people say that and we're going to go over Texas first, California here in a minute, but that Texas could be the most populous state at that point. And if you look as of July 1st of 2024, census data said that Texas was at like 31.2 million, California 39.4, but California's population is coming down some, and Texas is really growing quickly. So I think that that's a very, very realistic possibility, and I do not think it'll be 2060. I think there are a lot of prognosticators that say that it's going to switch even sooner than 2060 on Texas becoming the most populous state.
Speak of the devil. Next slide.
Yep. So the you can see that the average home price just sticks out like a sore thumb, and the average income in Texas is not lower than in California for the state as a whole. Obviously, there are pockets in California where Silicon Valley where incomes are extreme, but the state as a whole does not have higher income. But man, the homes just cost so much. Really an incredible number there. And whenever you think about these numbers, and it's almost cost twice as much to live there. That's why you're seeing so many people, amongst many reasons, move to Texas where the income is comparable, but the overall cost of living is so much less. Not to count even that the taxes are exponentially lower as well because there's no state income tax, which gives you a
Yeah.
lot more buying power.
I mean, just think about it. If you're saying if if the income statewide is relatively similar to Texas, then and we're having an affordability not crisis, but an affordability crunch just for real estate in general. Like I can't imagine what's going through the mind of people that are in California. My guess is that it is an extreme polarization of haves and have-nots. Where if you're in California and you own a home, great, good for you. You're making it. You're probably making a ton of money, and you're going to do really well. But the folks that cannot afford to buy a $800,000 home, they're looking around thinking, what am I going to do? And so I think that's a big part of why folks are moving out of California. Texas is a good, there are other states that are getting this growth, but it's just not, there's no American dream there where I can afford an $800,000 house. That's my first house. So it just makes sense that this is going to balance out.
Yeah. And supply and demand is the biggest driver there. I mean, you think about it. I think we've
Yeah.
shown in some previous charts. We haven't shown this in a couple of months, but um, at, and I think it's still the case. I read an article on it maybe in the last month or two, but Houston and Dallas, those two individual metropolitan areas have more open permits to build properties than the entire state of California. So there's a couple of reasons
Yes.
for that. Arguably, the biggest reasons is just regulations and red tape. Texas has far less, but there are also challenges over there. Like if you want to be a landlord, and I think up until this moment today, there are still people who haven't paid rent payments in California because of COVID, which sounds crazy, but that's still the case.
Really?
Yep, I'm still seeing that there are some of that going on, which is kind of crazy. But and then there's also rent controls being introduced in places like New York, where I mean, you think that that's good for the people, but whenever you say that rents are not allowed to go up over 3% annualized. If there's 8% inflation, how does the landlord handle that? Because everything is going to cost a lot more. And so I think sometimes these things have good intentions, but the reality is that whenever you decrease the free market, bad things happen. There's just not enough supply to keep the prices down. In
Yeah.
Texas, we had a lot of supply and it's keeping the prices down.
Yeah. I don't want to go off on a huge tangent, but I did see an article, a news story, some of the effect of like you said in New York, where they have rent controls, where the guy that owns the building or the units, it was rented, and he can only increase rents by maybe a couple $100 since the previous tenant, and it's going to cost him. And the place was trash. It's going to cost him like $80,000, $100,000 to fix it up, and
Yeah.
then that's to say nothing of like the cash flow. Like there's no way he's ever going to recoup that cash flow. So what happens? It just sits. Literally, it's just these buildings that are just sitting there, trashed out with no hope because the owner there's makes no financial sense at all for him to do anything really with the property. So it just sits there.
Yeah. So that's not a solution. That just impacts supply, right? Um,
Yep.
Nobody's going to build a new apartment complex. No one would build a new apartment complex in a place where you cannot increase rents enough to cover your expenses, right? It just doesn't make financial sense. Why would you do that? Yeah. So supply and demand is the ultimate. Like you can try and control things, but supply and demand is the ultimate equalizer. And you can see that in states like Texas where there's a lot of supply and prices go down and stay reasonable.
Yep.
All right, next slide. Jess, you want to take this one?
Yeah, I thought this was pretty interesting. So I'll read it and then we can talk about it. So a record rate of real estate fallouts. So these are
Mhm.
cancellation rates amongst properties that go under contract. And so it's a survey of agents, realtors, yeah, agents, as to like why did deals fall out in the last 90 days. So a new report shows 15% of purchase contracts were canceled. That is the highest rate for that month on record. Inspection slash repair contingencies accounted for more than 70% of buy side cancellations. Um, these things that were discovered during inspections. Major factor, and this was the big one, buyers have more leverage. More sellers than buyers in most markets, rising prices, elevated rates, and economic uncertainty are making buyers pickier and more willing to walk. This part I was didn't quite not sure why. Maybe have an idea, but regions seeing the steepest increase in contract terminations were Houston and San Antonio. But and I think maybe home inspection repairs are probably part of it. I'm not going to say that it's all nonsense. I think it's a large part of it. And one of the thought processes was, with rates higher than typical, and there is some affordability issues. Lower priced homes are the ones that are going under contract more often, and typically lower priced homes are going to be older and they're going to have more issues. That said, I do think if I'm a buyer and I change my mind, the easiest way to get out of contract is home inspections, because you can be unreasonable. You can demand everything you want. So while I do think there are some legitimate issues with home inspections and repairs, I think it's just buyer's remorse slash people wanting to get out of the contract because they have more leverage than they did back in the day.
Yeah, I think this is just um, it's just an opportunity for flippers to make better decisions. I can tell you early in my career, I would really get frustrated with some of these things and dig in and over negotiate the numbers. But I'll give a couple pro tips on what I did in the past and what I'm doing on the properties that I'm currently selling. And I think I sold six in the past couple of months, and every one of them has come back and requested repairs, and I haven't had one fall out. And I think it's just a mindset thing. One, I try to say I'm going to at least give them 50% of the repairs, right? So they ask for six things. I'm always going to do at least three. And largely, a lot of them are pretty inexpensive. So pick the least costly ones. So just mentally, you're at least giving them 50% of the things. And then secondly, what I look at is how much is this going to cost? And how much is it going to cost me in holding cost? And then future price reductions if I put it back on the market, right? Those things are significant. And make sure that the buyer does not send you the entirety of the inspection report, because if you get that, you're technically supposed to provide it to all new buyers. So you don't want to see that. If you want to see it to document anything, I would just ask for the specific pages of the issues that they're requesting, so you do not have to provide it to the new buyer. But in all candor, like I recently had to, person came back and said they wanted a new roof. I went and looked at it. We did not catch it whenever we are doing the initial repairs, but candidly, it needed it. And I normally do very aggressive price reductions so I don't get in a spot where I get in a, end up losing money anyway. So a roof, for us investors might cost you 5, 6 grand. If you got a $300,000 house, if you're being smart, you're going to be lowering it 5 or 6 grand every 15 days if it hasn't sold anyway. So it just made sense to do it and keep the person under contract. So I think if you handle this on the right way, it should not be that high. Now, admittedly, if you're a homeowner, maybe you're not as motivated. But for real estate investors, whenever you're paying all the holding costs, especially if you're paying hard money holding costs, you want to get in and out of that deal as quickly as possible. So being reasonable on the negotiations is pivotal for sure. Because you're just going to end up costing yourself more money. You're never going to get a better price in 90 days than you're going to get in the first 10 days. Just does not happen. That is the best time to get the best price.
Yep. I, so two questions. One, because you're opining from the perspective of a flipper slash seller. If you are an investor, I wonder if there's a way you think you can take advantage of these cancellations. I don't know if that's something that can be tracked or marketed towards. If you have some properties that are under contract and fall out, those are people that maybe you could reach out to if you are a buy and hold investor. There you go. Thank you, David. I guess that's you. Um, and the other thing that was interesting to me, I hadn't thought about this, but a lot of folks bought properties around pandemic time, and it was a completely different market. Like they were in their market when they bought property, like sellers in pandemic time, like they were getting offers over ask, no contingencies, like it was the Wild West. And so a lot of folks are not used to that with the market now, where it's flipped and the buyers have the leverage. And a lot of times the sellers are unwilling to kind of change their mindset.
Yeah. I mean, honestly, I think a lot of savvy investors just look at deals that have been on the market for a while and they're willing to make offers on those. I think that's the easiest thing to see.
Mhm.
Um, I'm unsure of how you target deals where sellers have made disclosures. I'm unsure of how you see that at scale, but I do know you see how long the property's been on market. And another savvy thing to do is to make sure that you're looking for the original list date because a lot of people will take it off the market, relist it, and there is a way for your agent to see
The
if that's
the
taking place.
CDOM, right?
Yes, the
Combined days
C
on market.
yes, combined days on market. Don't just look at the days on market. Look at the combined days on market. Great
Yeah,
point, Jeff.
yeah, yeah. I think there is a way in HAR to find canceled, but again, like to any kind of massive scale, I don't know. I'm sure there's people on here way better at that than I am. They might be able to figure it out. All right, go to the next slide. So I read this one. I just thought it was interesting because I've been driving to and from through North Dallas to Arkansas quite a bit lately, and every time I hit Texas, I start getting aggravated because the construction is just once you get a little bit into Texas between the Red River and Dallas, it's getting dicey, and so this Princeton, Texas, is the fastest growing city in the U.S. It's 46 miles northeast of Dallas, had population growth year over year of 30%. And this was the part that I thought was the interesting piece, the third bullet point. Growth is hot, housing prices are more affordable than a lot of the North Dallas suburbs. The median prices are 3 to 330, and I looked up where it was in the article, but the median price within the county, I believe, was, or whatever the comparison was, it was around 475, as opposed to this place, Princeton, which is 300 to 330. So that is a massive difference between this suburb and the median price 475. It's about 45 minutes out, which is not the end of the world. A lot of people commute that way. A lot of people work from home. So even if you are going in every so often, a 45-minute drive a couple days a week is not the end of the world. And you're able to get a way more affordable house. And so I expect these things to keep popping up all over the place. As long as you can stay within an hour of a major metro, I don't see any reason why these things, and you have access to freeways, obviously, which is going to account for that. But until you run out of freeway to go around, I can't imagine this is going to be the last time this happens. There's going to be another hot city 2 years from now that is about 45 miles from Dallas or Houston or wherever the case may be.
Yeah. People want to have access to the high paying jobs and the amenities, but they can get a more attractive price point as a starter home or just for someone who doesn't have as high earning of a job. Makes perfect sense. All right.
Next.
Another investor snapshot, Golden Triangle. We've been doing deal nights with Total Wealth Academy and the Seco Group, who's often a guest on this webinar. And this is a market that a lot of TWA investors and Seago Group have been really focusing on. And a lot of other investors out there are doing this as well. But it's a great market because it is an industrial powerhouse. There's tons of new expansion going on there. And just like the southeast side of Houston, this is an excellent renters market, excellent area for landlords because the people that work in these environments do not have the most stable jobs. It's not like a W-2 job. They're at the same company for 10 years. They often are 1099 employees or short-term W-2 employees and make a lot of money, like a lot of money. but they are not going to have that 2 year consistent income that allows them to buy a home. And they also may need the flexibility to be able to go in between the southeast side of Houston and the Golden Triangle, and or maybe South Louisiana, where there's a lot of industry, a lot of chemical plants. So they need that flexibility. They prefer to rent, but they are really good tenants. And also, they're pretty handy. You're not going to get as many repair requests. That's like a side benefit that often is a really
I
good
thought
thing
about
as
that.
well. But this is a really good market if you're looking for an area to invest in. And as a lot of gurus in the investment space say, live where you want to live, invest where you want to invest. The price points in this area are fantastic. The rents are very attractive. And while we say in Houston, Dallas, and San Antonio, you just don't see $400 or $500 cash flow a month, you do see it here. You do see it here with very low out of pocket. So if you're open to that and you want to learn more about it, please reach out to us because we can put you in contact with people that can get these deals in front of you. And every month there's a webinar, even if you're not local or if you're in Houston, you can attend where we present deals in this area as well as other markets that are really amazing. The ROI, fantastic. Sometimes the ROI is infinite because the deals are actually zero out of pocket with significant cash flow.
Yeah, I'll say if you're interested, I think we have a couple that are available via Seago Group. So if you are looking to pick one up, give your loan officer a call, email, whatever. We can connect you with him and see if the opportunity makes sense. But to your point, and we talked about this a long time ago in a presentation about a little bit of diversity. Like these properties may not have the consistent increase in values like houses maybe in the suburbs do, but they do have, like you said, whopping cash flows. So if you wanted to supplement some of your deals that are maybe cash flowing 100, 150 bucks, maybe not even, maybe they're flat, you could pick up a couple of these properties, usually pretty low out of pocket. And while you may not have the long-term expectations of growth, and maybe you do, maybe you get lucky, but you are going to get a lot more immediate cash flow right out of the jump. So it's a nice way to kind of diversify your portfolio a little bit if you're looking to pick up some properties. It's not that far.
I would say the appreciation is just a different type of appreciation, right? But like the fact that these are very economical prices in areas where the income is comparable to Southeast Houston and the homes just sell for far less, I do think that there's real appreciation opportunity. And even for investors, if you're purely looking at it from an investment perspective, you're looking at a net operating income. These opportunities are exponentially better than a deal in Houston. Now, there's some challenges, getting over there to look at the properties or keeping an eye on them and other things like that. There's not as many buyers. So there are some challenges. I'm not trying to say it's without any, but if you're just looking at it from a return on investment perspective, they're really fantastic. And that lends itself to having a lot of upside over time. All right. This next slide, Jeff, you want to run with this one?
Sure. So it's we've mentioned it a couple times, but it has to do with AI and land and power generation, mostly in Central Texas between San Antonio and the San Antonio Austin area. Data center development quadruple between the last 2 years and become the second largest data center market in the country. So the boom is creating high infrastructure, future ready real estate opportunities, especially in areas with strong power capacity. So power demand from AI workloads is now outpacing available supply, pushing operators to secure land. All this, it's great, but if you get down to the heart of it, it's basically this AI boom is pushing prices up in these areas because they need the land. So if you are investing in that area, I don't know if you have anything else to add, Wade, but if you're investing in that area, it's just one more reason why, in the long run, I think the San Antonio, Austin general area, even if they're having a few hiccups here and there, I think the fundamentals are strong. It's another diverse workforce. Like San Antonio, it's kind of a military town. This is certainly not military, so hopefully this will bleed over into that market as well. But it's just one more opportunity for these cities to grow, really.
I mean, the affordability index over time definitely impacts prices, right? Like people are able to pay more if they earn more. And these type of opportunities increase the average income significantly. And that allows for homes to go up in price. So I think that's a win-win if you're a holder of these properties, right? both from a rent perspective and from a resale perspective. The numbers should go up if people make more money in that area. All right. Uh, so this is interesting. Home builders are being aggressive. This is an indication of a buyer's market, like we've been talking about. There are people who buy directly from builders. This actually, for people who don't want to manage rehabs, can be a good strategy. We could definitely provide financing for that, both on a DSCR and a conventional loan basis. If that's something that you want to do, some builders are discounting those properties, and it could be a pretty good approach. I've seen people be successful with that. You don't have to make as many repairs early on, so there's a lot of advantages for it. You're not going to get that equity capture that you do on a traditional property. I mean, if they're discounting at 6%, maybe you're getting 6% equity capture, or you're often getting 25 or 30% on fixed to rents. But if you're really wanting to close to a passive type investment, that can be more of that strategy. But what you are saying is these builders, they don't like to have inventory sit for a long time. So it's not as if they're in a really bad spot, but they do like to turn that inventory because they have more properties coming offline. And so they're being pretty aggressive right now and trying to make the properties as attractive as possible.
I wonder how much of this is, I mean, this is a national thing. I wonder if Texas is significantly higher. I would think it is.
Yeah. Yeah. I think Texas has been pretty stable compared to some other markets. So, all right. So this next slide, Jeff, you want to run with this one?
Sure. It's just like we talked about. So Austin was rated the number one movable city in the nation. I was looking at the bottom left there. San Antonio, Houston, McAllen, and Dallas are 12, 13, 14, 15. So Texas is the only state to have such a large representation. Um, so it says about 38% of U.S. renters relocate to a new unit within 2 years. In Austin, 54% of renters move to a different apartment within 2 years, making Austin the number one move easy metro. This ranking factored in changes in local share of renters and rental housing supply to contextualize local rental. So I guess it's just basically telling you, hey, if you live in Austin or in these areas, it's easy to move around. You have a little more flexibility for the most part.
For sure.
Next
All right.
slide.
I'm going to move past this one in the effort of time. I want to talk about yes, the interest rate trend. So we've been talking about this quite a bit, and you can see that interest rate trend is you can't see it necessarily on this chart. It's such a long chart, but we are moving in a more positive direction. The bond market is definitely saying the rates are going to go down in the future. The Fed has talked about rate reductions next year, and as we talked about on this webinar, there's two factors that impact rates. One is the perception of U.S. mortgage bonds. That perception is improving. The spread between the U.S. government lending rate and mortgage rates has come down. That's a really positive trend overall. And then secondarily, whenever the government does lower interest rates, that has a positive trend as well. So we do think in 2026 we're going to see some improvement. But there was a time not too long ago when this average rate was in the sevens, and we're definitely trending in a better direction. But the other thing is just to get some context and historical understanding. If you looked at until 2000,
Two.
two,
Yeah.
this
Two or
was the
three.
lowest rate that ever was. So, if you look and people successfully invested in real estate in every one of these periods. There was not a single period in here where people got massively burned on real estate. If they held it, the values continue to go up. If you look at the historical average home price across Texas and across the United States, that has been an upward trend on both rents and on home prices. So you can succeed in any interest rate environment if you make smart buys. And now it is definitely a buyer's market.
Yep. Things change.
Yeah. Jeff, what do you see on the affordability
So
index?
just for if you guys have never been on here before, this is something we show. It's an affordability index, but it's really an unaffordability index because the
Right.
the higher ranked you are, the less affordable it is. So, for example, we were kind of talking about California previously. If you look at LA, for example, the average household income is 88K, but the average home price is $1.1 million. So if you just do the math on that, you're going to spend 84%, or the average citizen would spend 84% of their income on their mortgage payment. Um, and then it kind of goes down from there, right? 84 obviously is not tenable. I will say it's interesting that LA was up to 92 at one point. If you look back in 2019, 84 is the lowest we've had on record. So maybe things are evening out a little bit. But you see these charts, and you look at Texas, right? You see Dallas is 17th, it was 19th. 19th is usually in the high teens. Austin 27, pretty consistent. Houston moves around a little bit more than the others. Houston was at its, like I said, its worst. It was 23rd and 19, and now it's 36th today. So
Really
um,
not moving around, in my opinion. I think it's
what's
been
that?
constantly coming down. I think it's been 23rd to 30th to
Yeah,
36th.
yeah, I guess you're right. Like it's moving in one direction. So yeah, it's a little more volatile than the other cities, but it's becoming more affordable
Hmm.
based on these numbers. So
Yep.
it's a great way to get some perspective on how fortunate we are to be in a because if you look at a city like Dallas, for example, um, all of the amenities that it has, the opportunities that it has, those obviously those cities up in the top five are there's opportunity there as well. But I mean, you're not going to have much more opportunity than you are in Dallas or Houston for that matter. And look at how much more affordable it is. So I think that's like Wade said in the beginning. The bottom line is supply and demand, affordability. If you can come to Houston or Dallas and they can offer the same job opportunities, lifestyle opportunities within reason, and you can not go broke on your mortgage, you're going to have people move in. That's kind of my take.
Yeah, for sure. And we've talked about this before, but it's been consistent for a while. Average household income, Houston, Texas, 69,000. Average household income, San Antonio, 69,000. Identical numbers. And I think that's been a long-term trend. Look back in November 2024, those numbers are still very comparable. Houston was a little bit higher, but the home price in San Antonio, 264 versus Houston, 349, and the home price making costing 29% of your income versus 37%. That really gives upside there in San Antonio. That's been a consistent number that I think definitely says if you're looking for a reason to feel comfortable investing in San Antonio, that's a pretty strong one. But to Jeff, your point, that the trend in Houston is definitely better, going from the 23rd least affordable city to the 36th uh, least affordable
Very
city.
good.
That's a
Yeah.
pretty strong
Yeah.
trend. At 23, 30, 36. And in San Antonio is 56, 71, 71. So those two cities are becoming significantly more affordable. Now, Dallas has the opposite trend, Dallas, because it's gone up so much in value, 19, 19, 17. And then Austin is a little bit more affordable than it was a few years back. That's not surprising because it was just on a scorching pace a few years
Yeah.
back.
Yeah. Yep. So this kind of this, like you said, this kind of validates all the stuff you're seeing. And it's not that complicated, right? Where can you go and live and buy a house and still afford to do other things and not live out in the middle of nowhere? There you go.
All righty.
All right,
David?
David. We're a little early, but that's okay. We don't have our third member. So David, do we have a winner for our drawing?
Yeah, absolutely. It's going to be Ann Rogers. It's tuning in. So congratulations,
Congratulations,
Ann.
Anne.
Yeah. And so if you are watching this on a recording at some point in the future, which a lot of people do, I would really encourage you to try and attend the live event because we give away a really good option, which is half off of the processing fee. Is that right, David? Like a $750 value?
That's correct.
Yeah. So if you attend live, you are in the running, and yeah, that could be increase your profitability significantly on your next deal. So we'd love to see you attend live. And if you ever have any questions, you can certainly ask them. And just a friendly reminder for everybody, we have our information up right now. I would say that if you're attending calls like this, you're pursuing education, or even more so, if you're looking at properties, trying to find a deal. If you have not been pre-approved, I would strongly encourage you to do it for several reasons. If you're looking to buy an off-market deal or an on-market deal, there is no agent or wholesaler that will let you put a property under contract without either proof of cash or a pre-approval. We can get you a pre-approval very quickly and with a soft credit pull. That means it will not adversely impact your FICO score in any way. It will not show up for other people who are other lenders. It's like, for most part, other than us doing a soft pull and looking at your situation, no other lenders or score providers are even aware of it. So it's a great opportunity to find out what your pricing will be, what products you qualify for, and so that you don't waste time looking for a deal. And whenever you finally find it, you can't buy it because no wholesaler is going to let you put it under contract without that pre-approval letter. So if you haven't been pre-approved yet, or if you need to update your pre-approval, please reach out to us so we can help you out there. It's very easy, relatively painless. We'd love to help get you qualified so you can go out and find good deals. All right.
Yes, sir. Happy Thanksgiving, everybody.
Happy Thanksgiving. Be safe.